as you already mentioned, this presentation will be focused, and I think you can see the presentation right now, right? Yes. I'll tell you a little bit about 5E and how that came to be. As Jenny mentioned, I've been in the industry for 25 years, always in private banking. And over time, I started working at a bank as a private banker. And one of the things that we started noticing is that a lot of the gentlemen that we work with, a lot of our clients that visited us with their children and wives, we all of a sudden noticed that most of the women that were there were listening attentively, and some of them understood very well what we were talking about. But I realized that we were always coming from a very, I would say, a male-dominant type of language, or a very banking type of language, and we weren't really passing the message across as we should have. And in one of those occasions, one of the clients, or a woman client, said, I don't understand anything you're saying. And if tomorrow my husband passes away, I really have no idea what I'm going to do. And I think that struck a chord with me. And I said, I think as women advisors, we need to do a better job in communicating and in transmitting the messages that are important for women investors and women that inherit wealth. And so that was back in 2006, and we developed a beautiful program for women at this large institution in Switzerland, and later became a very important program to help women understand how to manage their wealth and how to manage their relationships in the financial industry. Fast forward now, and I decided that I wanted to continue this passion, and so that's how 5E Wealth Lab was created. I've been working a little bit on this inspiring idea for some time now, and finally I'm able to present as 5E Wealth Lab. But what it really stands for is to be the bridge between the soft and the hard facts. And 5E is what it is. It's the bridge in our financial ecosystem, and it really brings in women at every aspect of that ecosystem. So from the top as women investors, women that are advisors, women that work in the institutional side of the business in finance, and at the bottom, I would say, are the women entrepreneurs. And so we, as women that are in this industry, we should start bringing in the women at the different, I would say, the different parts of the ecosystem, so that we have a nice circular flow where we can all be part of. This beautiful, it's a great market to be part of. And I think if more women were involved, we would really see good capital go to good things. And that's the whole purpose of 5E Wealth Lab. So with that, let me introduce you to, we're going to do a presentation that is very, it's going to be very basic on capital markets. So for those that are experts, I hope that you don't get bored, but please do share anything that you'd like to share at the end. And we are going to leave a little time for Q&A. And so we will start. We will start with the basics of capital markets. Then we will focus a bit more on bond risk and equity risk. And I wanted to talk a little bit about the power of asset allocation and the power of staying invested, especially with the market performance that we've been having in these last, I would say, those last 9 months, because we started a correction back in November. And then 2022 has just been really horrible for markets. And there's a lot of reasons for that. And I'd love to discuss that more with you. But for those that wanted to learn more about the basics of capital markets, I think that, oops, sorry, one second. I'd like to always start with what is the definition of capital markets, as it is really in the dictionary. How do you define capital markets? Because we constantly talk about all these terms. We talk about many different languages. The language that we use is very complicated, and sometimes it means the same thing. So I wanted to kind of start with really the basic. How does the dictionary define capital markets? And I wanted to do a little tweak to that, because a lot of you are involved in sustainable investments, and obviously by being part of Invest for Better, you are interested about having impact with your capital. So I do a little tweak about the definition of capital markets that I hope you enjoy, and why it is important that you continue your journey in impact. So the basic definition of capital markets is the purpose of capital markets is to facilitate the circulation of capital, so that's money, among participants in the economy. And those are really the participants are people such as ourselves, companies, and governments. Now, the interesting thing is that this is what this has been the definition for years since the stock market exists, and obviously since exchanges have existed one way or another. But now that we talk a lot more about impact, I wanted to add to this definition what we really do when we talk about sustainable investments and impact. And so I changed here, the purpose of capital markets is to facilitate the circulation of good capital among participants to positively impact the economy, the environment, and society. So in other words, instead of just focusing on a few of the stakeholders that obviously benefit from the markets, let's benefit all stakeholders. And I think many of you are very familiar with what that means. But could you imagine if the definition of capital markets actually included this? Everybody would be doing wonderful things with capital. But moving on to the basics of capital markets. So in a simple way, think of participants as lenders, which are investors, such as ourselves, borrowers, which are the companies and the governments. They're the ones who need the capital. So you have to see yourselves as the ones that are providing the capital that is needed by companies and governments. So you see, when we do that mind shift, it's very different, because then you become a participant and you are empowered to participate in the capital markets because of this sole definition. And then we have the intermediaries, which are the banks, logically, and the institutions, the financial institutions. They're the ones that at the end of the day connect lenders with the borrowers in the marketplace. And so here we have now what we call exchanges, like the New York Stock Exchange, for instance. How do participants meet? They meet by issuing and trading capital market instruments, and they're commonly known as securities. A lot of people get confused with what is a stock versus a security versus a financial instrument versus an investable asset. And I think all of these words tend to confuse us and drive us and push us away from understanding capital markets. But really, at the end of the day, just think of it as this is a market, like a food market. And what we're really trading is if we were trading food or we were trading any other commodity, here what we're trading is what we call instruments or securities. This is technically what we're doing in most of the exchanges. There are many different types of securities, of course, with their own terms for trading in the capital markets, and some of these sub-markets are. And this is interesting because this is where we start going into the definitions of, well, what are some of these markets? And the markets that we normally define as the markets are the stock market. So this is where we trade equity or we trade stocks, the bond market, and this is where what we call fixed income from a portfolio perspective, and this is where we trade debt paper or bonds. The money markets, these are the typical money markets, are really the short-term paper or short-term debt that is traded amongst companies and governments. Foreign exchange markets, which you probably have listened to or heard or read about, these are technically the currency markets. So every time that we trade on euros versus dollars, or Swiss francs versus euros, or British pounds versus Mexican pesos, they're a very important part of our market. And we have obviously foreign exchange markets. Then we have many of you have heard of the Chicago Stock Exchange, where we trade commodities, and the commodities exchange. So this is where we trade coffee, we trade gold, we trade platinum, we trade cotton, and what we call soft and hard commodities. The hard commodities tend to be those that we refer to as gold and platinum and silver, and the soft commodities tend to be usually those related to food commodities. And we also have what we call the derivatives markets, which is a very complicated financial structuring type of part of the market. And I'm not going to go into that detail, but for now, I think we're going to keep it to stocks and bonds, because those are really the core aspects when you build a portfolio. And I think as we begin the investment journey, two of the things that we really need to be familiarized with is truly what bonds are, stocks are, and the relationship between these two, and how that affects your returns and your risk in your portfolios. In addition to that, what's also important is that there are many other instruments, or what we call other instruments, that belong to asset classes, that when you combine them to your bonds and your stocks, which is what I would call really the heart, so the core of your portfolio are the bonds and the stocks, everything else around it, think of it as these are your opportunistic, these are your nice to have, or your risky type of investments that add that flavor to your core portfolio. They're the ones who add that color, the spice. They're the ones with a higher risk. And so all of those things around your core, which are your stocks and the bonds, are nice to have, but you really need to understand how your core works, because at the end, that is what really gives you your return over time. Everything else is when you get more experience. One of the things that I believe it's important to understand when it comes to who are those participants in the capital markets, as we call stakeholders, and here I'm going to do something different, is that I'm adding more of the stakeholders. So as mentioned, the three primary stakeholders that we are familiar with in capital markets are the governments, which are right here, the governments, suppliers and vendors. Those are the second most important stakeholders currently in the markets, in the capital markets, and obviously the investors, such as ourselves. But when we talk about stakeholders and that part where we were saying, could you imagine if we did, capital for good and so forth, the other stakeholders that we need to be now more familiar with in terms of how our investment and our capital flow affects them is when we look at employees and how companies are treating employees, how employees are being paid, what are the labor practices at these companies. Not just looking at the companies themselves, but you also want to see how that company, what's behind the company and how they operate with their employees. Secondly, customers. How does the product and the services that those companies put together really affect the customers from a safety perspective, for instance? Then we have communities. Well, how do the companies that you invest with, how are they affecting communities around them and where they actually participate or do business, whether that's in the United States or outside the United States? We also have, in addition to employees, customers, communities, now we have a big one, which is the environment. How are they really affecting the environment, and how serious are they about how they use resources? And I think that now more and more, thankfully, to the whole concept of sustainable investments, which have existed since the 70s, but more so now, and thank you to shareholder activism, now we're making companies more responsible about these stakeholders. Why? Because it reduces financial risk. So sometimes we focus a lot, it's a nice to do, but at the end of the day, we're truly focused on what the purpose of capital markets is that we are reducing financial risk. So it is important when we invest that we are aware how these companies are affecting all of the stakeholders, because at the end of the day, it is going to be shown in the numbers. So if we go into the mechanics, a lot of people say, well, this is great. This is the capital markets definition. And well, how does it work? Capital markets, and I love to describe this because capital markets are, at the end, as I said, exchanges or marketplaces where things are traded. So here we call them instruments, which are securities, and they're bought and sold. So we've already established that. This is what is traded. Two things that are important to keep in mind is that there is the direct trading aspect and the indirect trading. So how does that work? So when we say we are directly trading in bonds and stocks versus we are indirectly buying stocks and bonds. So you as an investor can participate in either way. When you say trading directly, it means that you are actually buying bonds directly. So you're going to a company that the company has issued debt, and you are going to lend them capital, right, as a creditor to the company. So you're technically buying a bond for, let's say, Apple, and Apple then issues, when they issue the bond, they actually promise you that for a period of time, they're going to be paying you a coupon or an interest rate. And I'll go into the details later. But here it is when you decide to go and buy a direct bond from a company, or you actually buy bonds through other means or other intermediaries, or what we call other instruments. And those instruments then have the list here, which are usually mutual funds, exchange traded funds, or other. So that's what we would call trading indirectly in bonds. You do the same with equities or stocks. You either buy stocks directly from a company in the stock market, or you can then choose to buy a mutual fund, or what we call a collective investment vehicle, where you have, instead of one stock, you have 50 stocks in the technology sector, for instance, or 50 stocks in the US market. And this, what it does is that I would say that today, if you are into trading, if you really love to understand markets really well, and you're really versed in markets, and you like to buy and sell stocks and bonds, well, you can do that directly, and you're actually going to have a higher, I would say, from an impact perspective, you'll probably have a larger impact when you invest directly, but you have to be really versed and have the time to trade in the markets. So another way to participate, which many of us, I would say, a grand majority of investors do today, is they participate by buying these collective instruments that are composed within it of bonds and equities. Mutual funds is one of the most common ones, and this is what we would call indirectly trading. So I could go and buy a mutual fund that is either composed 100% of stocks, or composed of stocks and bonds and cash or money market instruments, and composed of other instruments. And it becomes a bit more complex, but it's really easy in terms for you to build a portfolio that is not just concentrated on stocks and bonds, but that you actually have the universe of the entire market, and you can select exactly how you want your risk to be allocated, and in terms of allocated in the bond market and allocated in the equity market. So it's just an easier way for us to participate as investors in the market, and not, if you go back 50 years, or I would say 40, 50 years, not a lot of people were using mutual funds to invest in the market. They would actually go directly into stocks and bonds. And that just became very tedious for many investors, especially those investors that are not very, informed or educated about the markets. And so mutual funds and all of these other instruments started becoming popular, also because it in a way, it's a much easier to be diversified when you have these type of vehicles. And if there is a market crash, in a way, your impact or your result in these instruments are going to be much less, I would say, hectic than if you were invested directly into individual bonds and stocks. It's just another way to diversify. So here we have mutual funds, exchange traded funds that I know a lot of people have been familiar with. UCITS is the equivalent of ETFs or exchange traded funds in Europe. We have the famous index funds here as well. A lot of people are familiar with REITs, or what we would call real estate investment trusts. These are also collective vehicles that own stocks in the real estate market. Listed hedge funds. Hedge funds has been around for quite some time, and after the financial crisis, a lot of them got wiped out, and this new, I guess this new thing came out about having listed hedge funds. And hedge funds at the end of the day are very complex funds that engage into financial structuring, so hedging against the markets, but they allow you to participate as an investor. And when they say listed, it means that there is liquidity. Prior to 2008, most of these instruments were completely illiquid, or you had very limited liquidity and access. And today you have access and you have liquidity. So markets have also sophisticated after the financial crisis. And then afterwards, if we go into stocks and actually what that really means, because a lot of people ask, well, what are really stocks, and how do we understand what stocks really mean when we buy them? And these, again, they're equity instruments that represent a partial ownership of a company. It is through issuing stocks that companies raise capital. This is how companies finance themselves, by issuing stock. They're willing to give up part of their ownership to you so they can finance their growth plans, for instance. So they sell a portion of their companies to interested investors. These are ourselves or institutions in the primary market. So when we hear let's say when Airbnb went public and they did an IPO, they actually went to the primary market first to get interested investors. And once they did an IPO, then they start trading in the secondary market. And this is when everybody comes into this exchange to trade and or buy and sell this stock based on, whatever I would say whatever you're looking to do with that particular investment. So here you have buyers that are investors that become sellers. They sell for a profit or they sell for a loss in the secondary market. And this is really where we all participate. Many of us are considered retail investors. So that means that we're already participating in the secondary market. It's very rare for retail investors to participate in the primary market. Mostly the primary market is reserved for institutions or very large financial clients. But this is how most of the companies raise capital before they become also public. If we look at bonds and the terms that we use with bonds are a little bit different from stocks in that you are lending to the company. The company is actually asking for capital. They're borrowing capital from you as an investor. And the company, when they borrow funds, usually it's to finance either very capital intensive projects, or they're actually borrowing to meet short-term needs or long-term needs. The relationship here is different because it is one of a borrower or and a creditor. Just as if you were to go to the bank and get a loan from, JP Morgan Chase, you have an agreement with the bank. The bank issues a loan, and you have to repay the loan and pay an interest related to that loan. This is exactly the same relationship. It's just that this time you as the investor are lending to the companies. And there is a contractual agreement. It's called an indenture. And we'll go into the details of the risk associated with bonds. Actually, bonds, at the end of the day, in our opinion, as many professionals would say that and agree with this, is that bonds is probably one of the trickiest investments to make in the stock market, in the capital markets. They're very complex to understand, and the risk could be humongous if we don't really understand what we're investing in. So this is where the mutual funds and the index funds come in, because those managers help us understand all of these intricacies related to the bond market. So there is a contractual agreement. When you're buying a bond, you're technically have a contractual agreement. You don't see the contractual agreement, but you can request one. And that is between the lender. So you are the lender, the investor. There is an interest rate that's defined. So that's what we call in the bond market the coupon. And coupons are directly related to I would say the credit worthiness of the company. So the better the credit worthiness, the less coupon you're going to receive, because that means that it costs them less to finance themselves. The less good credit worthiness, it means that they have to pay a higher cost to finance themselves. So the coupon you're going to receive is going to be higher. So this, you see how you start now weighing the risks between a higher coupon for your portfolio versus a lower coupon for your portfolio. But then now you have to say, well, what type of credit worthiness would I prefer to have in my portfolios? Well, when banks are lending you money, they're also looking at the credit worthiness of each individual client. And as you know, if your FICO score is below a certain number, well, it's going to cost you a lot more money to get a loan at a bank or a credit card. And if it's a very good FICO score, you're probably going to get a much better rate, in a much better lending rate that others would. This is exactly the same as it happens in the bond market. Obviously, this is a predetermined. Bonds are usually predetermined periods when they will return the capital back. So they're actually either guaranteeing or not guaranteeing, but normally they're saying, we will return the money back. We will give you your money back that you lent to us, either in a year or 2 years or 10 years or 30 years. And obviously they're promising to return 100%, but sometimes that doesn't happen. So when we invest in bonds, we need to ensure that there is a lot of things behind it that will tend to guarantee to us that we're actually going to get paid back. And we'll go into the details of the risk associated with this. Then the bonds, I like to always talk about the bond risks because they're the most complex. But when we talk about bond risk, this is where it gets a little tricky. And I know that most people don't read the contractual agreements or the indentures when a bond is issued. But if you invest with a bank and you invest in mutual funds, the manager who's investing in those bonds, they're very familiar with these contractual agreements. They have to understand everything that's behind it. In other words, is it guaranteed or not guaranteed? If it's guaranteed, what is it guaranteed with? If a bond that belongs to a real estate company, are they guaranteeing it with their own real estate assets? Or these are non-guaranteed loans or bonds? If you remember back in 2008, one of the biggest crises that we had was the subprime crisis. Why? Because these were non-guaranteed, unsecured loans, very bad credit worthiness. And when the market crashed, there was nothing behind it guaranteeing that they were going to return that capital back to you. So when you invest in bonds, you have to be very familiar with the interest rate risk. This right now is very important in our current market environment because of where we are with interest rates and where we are with inflation, which I will talk about a little bit later. But we have the interest rate risk, the credit or default risk, which is what I was just mentioning, related to the crisis in 2008, and the prepayment risk. And prepayment risk is technically you have a person that tells you, I'm going to pay you 10% or 5% for the next 10 years. If in the indenture they have an option or the flexibility to pay back the capital ahead of time, it means that now you're not going to be obtaining 5% for the full cycle, the full period of 10 years. It means that you're going to have an opportunity cost. Well, that costs money because if in that moment when they pay you back your capital, which is great, you get your capital back, you got 5% for 5 years. But if interest rates are very low at that point in time, and it's very difficult to obtain a new bond for the same income of 5%, maybe it's 1%, then you just missed out on 4% for the next 5 years. So that's what we call the prepayment risk. And these are, there are bonds that actually specifically say that they have the option to pay ahead of time. Most bonds come with ratings that describe their investment grade. So this is what we're talking about, credit quality or credit worthiness. Usually we talk a lot about investment grade or AAA or AA. Hello? Can you still see my presentation?
Yes.
Oh.
Yes, something strange happened, but it didn't affect it.
Okay. So we talk about investment grade, credit quality, and credit worthiness. Obviously, when in determining risk it's interesting because depending on where you are in your cycle in terms of your age and your time horizon, a lot of people, when you invest, you're going to have to decide whether you want to go with high quality or good credit worthiness, or you want to go with less credit worthiness but with a higher income. And usually the rule of thumb is if you have time is always on your side. So if you have time, then obviously you can take a lot more risk and you can take it with less credit worthy companies because you have time to recuperate in case something bad were to happen. But when you don't have time, you want to go with investment grade issuers. You want to go with those good credit worthy companies. Then we have the credit quality. So the higher the credit, obviously, the higher the credit risk. Sorry, one second. The higher the credit risk, the higher the coupon. So the cost of financing is high, like high yield bonds that many of you have probably heard of. So they pay very high coupons, but you have a very high risk. The higher the credit quality, the lower the credit risk. So they pay a lower coupon. And so the cost of financing for them is low. And obviously for income is obviously low. So an example is US Treasuries. What does that mean? A US Treasury could be paying you 2% today versus an investment grade bond that could be paying you maybe a 3.5% coupon versus a high yield bond that could be paying you today maybe 5.5% coupon. And you have to decide, what am I willing to risk? So that gives you kind of an idea. And the beauty of the bond markets is that the gaps between those three that I just mentioned, the fantastic thing is that that is constantly changing, and people are constantly trading on the differences between what is a treasury and what is a high yield bond. Yields is how we measure performance for bonds. And so when we say this, if you're buying, and this is difficult to understand for those that are not familiar, but when bonds are issued, so for stocks is really easy. The price is the price. You buy at price. Either the price goes down or the price goes up. If it goes down, you obviously lost money. It's unrealized if you haven't sold it. If it goes up, you obviously made money, and it's realized if you sell it. With bonds, when bonds are issued at issue, they're normally issued at 100. That's your point of reference. That's your starting point. So bonds can trade below 100 or they can trade above 100. If you buy a bond below 100, it means that you're buying at a discount. So instead of paying $100 for a bond, you're paying, let's say, $95 for a $100 bond. At the end of the term, you're going to receive $100 back. You're guaranteed $100 because you bought a $100 bond. But because you're buying at a discount, that 5% discount, that's added to your coupon. So if that bond pays you, let's say 5% per annum, but you bought that bond at a discount in the market of 5%, you add that 5% that you're going to obtain from 95 to 100 to your coupon over time. And that at the end of the day becomes your yield. Same happens if you buy a bond that is very expensive. So let's say you're buying at 105 and your coupon is 5. Let's say for the next year. So even though you have a coupon of 5%, but it costs you a 5% premium to buy that bond, you have a 0% return over the year. Now, the longer the bond, well, obviously you'll make up the loss of your premium or what it cost you to buy that bond, which was expensive. So obviously you want to go for that 5-year, 10-year type of duration or maturity, so you can make up for the cost that you had to pay to get into that bond at the beginning. So these are very interesting concepts of bonds, but one that we have to understand. Also, there is something very important, is that when a company liquidates, actually the bond investors are at the top of the capital structure. So if a bond or a piece of paper is guaranteed by the assets of the company and the company goes bankrupt and they have to liquidate, you will be the first one as a bond investor to receive part of that liquidation. The last people to get paid are the equity investors. Those are the ones that lose the most. So technically, when you invest in a company that goes bankrupt, the chances of getting that money back is almost nil, which is not the case with fixed income or bond investments. The reason why we were saying that it's important to understand if a bond is guaranteed or is secured by something, an asset, is because when they're not secure or guaranteed, it means that if they go bankrupt, nothing, if there's no value behind, there's not really much they can give back to the bond investors. This is interesting because this is what's happening right now. And it's important to understand how your bonds are affected when interest rates increase. So for every increase of 1%, this is just an illustration, but it says for every spike of 1% in interest rates, which is what we're currently living right now with the Fed, this is how your bonds, depending on when they mature, how they get affected in terms of their price. So if your bond is going to mature in the next 12 months, you have no impact. So the impact of interest rate increases by the Fed, if you have something very short term, is almost, you're not going to see it, is almost non-apparent. If you start increasing your duration to 2 years, 4 years, and 6 years, this starts showing how the price of your bonds start. Obviously, it's different for a different credit quality, but this in general, will say, well, your bond portfolio could drop 2% in value if there's a spike of 1% in interest rates. And if your bond expires in 4 years, so let's say today's 2022 and it expires in 4 years in 2026, it means that your bond portfolio is dropping 4%. Now, if it expires in 6 years, we're talking about a minus 6% drop. Today, though, and you'll see this in a graph later on, we're having a phenomenon that we have never seen, and that is that interest rates have not increased that much yet. And we're having drops of about 10% in our bond portfolios today. We've never seen that in 40 years. So technically, this graph illustrates a pretty normal market. It does not illustrate what's going on right now in the markets, and I'll show you that in a second. This is the relationship between inflation and interest rates. This is important because we're stopping here in 2020 in this graph, and you know what has happened in the last 2 years, which is inflation has increased tremendously. We have not seen an increase in inflation that we have seen and so rapidly since 40 years ago. So this is interesting when you see that inflation has always run at a 2% average rate for the last 10 years. The rolling rate of inflation has always been 2% from the 70s forward. And now inflation is running now at 9%, although the average goes down to about 4.5% in the last 10 years or 3.5%. The point that inflation has been stubbornly high in the last 12 months and increasing every month a little bit more. So we started with an increase of all of a sudden inflation went from a 2% to 2.8 and then 3.5 and then 4.8 and then it was 6 and then it stayed there at 7-8% in the last 8 months, and now we're at 9% since our last report. That means, and it's important to know inflation because there is the mainstream inflation, which is the one that all newspapers and most of the media announces is inflation is at 9%. But you really have to understand, what does that mean, the 9%? Because there is the mainstream inflation and then there is the core inflation. And the one that we really care about, at least when we manage portfolios, is the core inflation. So what does that mean? Inflation, the mainstream inflation, is the one that includes gasoline prices, and it includes food prices. That's what's been causing most of the disruption in inflation in these last 24 months, especially the last 12. That obviously we've seen an increase in gasoline prices, and we've seen an incredible increase in food because there is a shortage, because there are supply chain disruptions, and this has caused an increase in those two areas. However, monetary policy and fiscal policy in a country do not directly affect the price of gasoline and food. The Fed cannot control those two items. So when we extract food and we extract oil, gasoline prices from inflation, we get the core inflation. And here we get so we extract that, and then we really can see, are services going up? Is rent going up? Are labor costs going up? Is the cost of clothes going up? School going up? So then we really see what the true economy is doing. And when you compare today's inflation of the 9%, which is the mainstream inflation, versus the core has actually started going down in the last 2 months since May, and that is at 6%. But then remember something. The mainstream or the media is always reporting lagging. So they're always about a month or 2 months behind. So these numbers that you're seeing in the news of 9% and then 6% for core is actually reporting what was really happening in the economy 2 months ago. Today, we seem to see that that's actually dropping a bit, and we can see it in the core inflation. What's really holding up this high level of inflation, and everybody's saying the economy is horrible, but it's not, is because we have this issue with gasoline and oil. We think that that's starting to go down now, and we should see a little drop in inflation in the coming months. But because of that, the Fed has had to increase interest rates, because if they don't increase interest rates, then there's too much liquidity in the market. And that means that there's more money to spend. And the more we spend, the more that we push our prices up. And so the Fed has been very aggressive, as you probably heard in the news or you've read in the papers, that in order to put the brakes in the economy, they are forced to increase interest rates. And so here, I would say that we are very similar to 1973 when we had the oil crisis, and we had interest rates that started going up, which is the yellow line, and inflation started going up. And you can see that in order to combat inflation, the interest rate, which is the green line, had to catch up with the inflation rate. At this point over here, this was the highest point. But can you imagine interest rates hit 20%? Today, the Fed has only raised 1.75%. So we're not even close to the 20%. Now here we have an inflation of 15%. When you see at 9%, if we were to have 9% every month for the next 2 years and then continues increasing, I would not be surprised we would be in this scenario. Because at some point, the Fed, instead of raising 1%, they're going to have to go 2% up or 3%. And over a period of time, you can easily get to a 20% interest rate. The difference between this crisis and where we are today is that our economy is functioning. Our economy is still very robust. Our economy is still producing. We have very low unemployment. We still have a lot of jobs available. People are still spending. The savings rate is very high now in the United States after the pandemic. So there are a lot of factors that we did not have in prior crises. And that is the phenomenon today, that we don't understand why the economy, it's so robust and it's doing well so far, even though some are saying that we're entering a recession, but it doesn't seem to be a bad recession. It's like a benign recession. And we're having a market that is going a little bit crazy. The market is going crazy because it needed to correct. The market had been going up and up since 2009, and it needed a correction. And now obviously we have phenomena such as the pandemic and many other things like supply disruption, China, Russia, and so forth, energy crisis that have extrapolated, have made things worse for the financial markets. But it's not to say that it is caused by a crisis per se, and it's not caused by an economic crisis. That is the big difference right now. In terms of equity risk, before we go into the equity risk, what's important about the equities and why they're important in your portfolio when you combine them with bonds is because the way you make money is by receiving dividends or by capital gains. Dividends is what a company distributes as profits per share, and they usually distribute it back to you as the investor in cash or other shares. The other way of making money with equity is simply when you buy and you sell at a profit. That's a capital gain. So you buy a stock and tomorrow you sell it, regardless if you sell it in 2 days or 2 years. If you buy it at a higher price than you bought it, so the idea here is that you want to buy low and sell high, well, you have capital gains, and that's how you make money in the equity markets as opposed to coupons and pricing in the bond market. Then the risks associated with equity are obviously market risks, which we are seeing right now. So stocks will rise and fall in value based on all the market forces. We have credit risk, which we kind of talked about a little bit with bonds. Yes, it is important to know if a company has credit risk. So their stock may be valued very high because everybody likes their stock. Like I believe I forget the name of the company. I think it was Robinhood. So you can invest in a company that everybody thinks it's valued at a higher price than really the real value if you extract their debt. And at the end of the day, their credit risk is super high. So at any moment, their stock can go from going up 200% to dropping 500%. And you're left with nothing. So you do have to understand what is the credit quality of the company before you buy their stock and their bonds. Foreign currency risk. So for equities that do, for instance, you can have a company such as 3M in the United States that does a lot of business in the US, but they also have most of their income or grand majority of their income coming from outside, so from other countries. When those profits come back to the US, that means that the currency risk is associated with that. So your profits may actually go down when you exchange it back to dollars. So there is a currency risk associated with doing business outside of your immediate country or your local country. There is political risk. So obviously we're seeing political risk in Europe right now. And we're seeing political risk in emerging markets in Latin America right now. Why? Because aside from Brazil, all of the markets, all of the countries in Latin America right now have unfortunately turned to very leftist governments, and they're not very pro-business or pro-capital markets, and that affects economically the countries. We understand Brazil may actually be the last country that we don't know if they're going more towards a leftist candidate or a more conservative candidate, but these sort of decisions affect markets tremendously, especially with markets that are not well developed yet. This is a huge risk. So when you're buying stocks from companies that are based in other countries, you need to understand the political environment in that country. And obviously economic concentration risk. So a company's value can fall if it's too concentrated in a single sector, or if it's concentrated in a single country. So you want to invest in companies that are well diversified. So for instance, if you invest in a car company that is only concentrated in the east part of the United States, and it's only concentrated in regular vehicles, and it's not investing in technology, or it's not investing in electric vehicles or selling electric vehicles or developing, innovating electric vehicles or other forms of transportation, then this is an incredible risk, knowing where we're going in the next 10 or 20 years. And so when you buy a company, you want to understand if these companies are moving forth with their growth plans and their innovation, and how they are diversifying their concentration risk, or are they staying in their niche market? Some companies staying in their niche market, that's the best they can do because nobody else does what they do. But if these are companies that have to compete with others, and others are getting ahead and these companies aren't, well, you're obviously certain that you may want to start investing in companies that are a little bit more diversified in that aspect. The two other risks that I would say are very kind of in front of all of us right now is obviously inflation. Inflation is what has affected the performance of capital of stock markets and also bond markets today. Why? Because when inflation goes up, the company's profits go down. And we are always forward looking when we are estimating what the potential price of a company will be in the future based on their projections. And you have to add a higher capital cost, that brings your profits down. And so your price of your stock has to go down. Because inflation has gone up so much, that has actually brought down the price and the value, the present value of most of these companies. And what it has affected the most, obviously, are all the companies that we call growth companies. Most of them are technology companies, innovative companies that have been doing very well in growing their markets and growing their companies in the last few years. But when, they had free capital in a way they were financing themselves at 1%. 2%, that's beautiful. Usually you finance yourself, a company can finance themselves at 4 or 5%. So when the cost of capital is so low, you have all of a sudden, this inflow of additional capital and liquidity into the market, which is what has created a rally in the markets that some of us saw and said, this is not sustainable. This is why the correction is happening. Inflation also affects, if the inflation continues going up, not only is it affecting capital markets, which is what we're seeing today, but eventually it will start hurting the economy. And when it starts hurting the economy, because that's us, when it starts hurting the economy and people are not buying homes anymore, or they're not getting loans anymore or mortgages anymore, and they're not buying luxury items anymore, or they're not traveling anymore, that's when the economy kind of freezes itself. So right now we're kind of doing a dance with the Fed, where they're raising little by little, and the market is reacting, and the economy is still there. And so that dance is so important between the Fed and the markets and the investors and the economy. And so for you to be, it's a fascinating thing if you are interested in reading about it, but understand that this is the relationship that is going on right now with this phenomenon of inflation, the Fed, and the economy. ESG risk, I believe that with many of my colleagues, we believe that if companies do not start looking at ESG risks, in the future, they will have huge financial, negative financial impact. And this is, as investors, we have to be responsible in managing the financial risk associated to companies or sectors that are being inactive in the ESG front. So environment, things related to environment, social issues, and governance. The more the companies start adapting to these three areas, the easier it'll be for them to navigate the financial markets and to also raise capital in the future, because investors, which are us, the lenders, will be more likely to lend to companies who are foreseeing these potential risks eventually in the next, in the coming years, especially related to the environment, to social issues and governance, more so that they will lend money to companies who are not doing anything about it. So for me, sustainable and ESG, besides the fact that it's positive for all of us as the world, because we're making it a better place, it also affects us financially, because the financial risks are very large if companies do not pay attention to this. There could be lawsuits, there could be a ton of other financial costs, and the price of your stocks will be negatively affected by that. And the price or of financing or getting capital for bonds will be huge for companies. They're going to have to pay very large interest rates in order to finance themselves. In fact, we are seeing it today in Texas. In Texas, because the lawmakers decided that if banks are have policies that are for or rather against fossil fuel companies and investing or continuing to make larger investments in the fossil fuel industry, that they don't want to do business with these banks. And a lot of banks have pulled out of the Texas market, banks like JP Morgan, like Bank of America. By pulling out of the market, now the municipalities have to finance themselves, and it's costing it a lot of money. It's between $300 to $500 million in additional interest costs, because now they have to go and finance themselves with smaller companies, with smaller banks. And this, at the end of the day, is the taxpayer who's paying that. Mm-hmm. So when you're looking at a company, you kind of have to look at a company in the same way when it relates to ESG risk. This is just now going into illustrations of performance and actual market risks. This is an interesting chart that was shared with us by a bank, and they were putting here, okay, well, what is the performance of all equity markets, developed equity markets? Developed means these are developed markets are the main markets like the US, the UK, Canada, Japan, most of Europe. Those are developed markets. And they took all of the equities since 1956 all the way to February 2022. You can see the crisis here, right? You can see the crisis of the 70s. So that's the oil crisis. Interest rates in the US were 20%. You can see the incredible drop there. Then you see the crisis of 2000. This is the dot-com crisis that we had late 90s, early 2000s. And then here is the financial crisis that we had in 2008, which has affected us a lot. But if we take the 5-year rolling median return, so constantly 5 years average return over that 5-year period, the returns have been in all equity markets 12.4% up to February 2022. We weren't losing that much in the equity market then. And the volatility, which at the end of the day is the risk associated with that return, was 6.6%. When we're talking about efficiency, we want to have portfolios that when you mix your equity and your bonds, as I was saying, that's your core of your portfolio. You want to make sure that that risk is way below your potential return. What you do not want to have is that your equity market has a return of 15%, or your equity basket has a return of 15%, but it took you 15% of risk to get to 15% return. It means you took too much risk. So we talk about portfolio efficiency. And so the lower the risk for higher the return, that's what we call efficiency. That's what we call when a portfolio has been efficiently managed. And so what we're trying to do when we invest is we're trying to get the lowest risk for the higher return. Obviously, it's not always possible, but that's the relationship that we're shooting for when we're investing in the market. So this gives you a little bit of an overview of what all developed markets have performed. Now, if you just take the S&P 500, the numbers change in volatility. It actually goes up to almost 14%. Volatility is risk, by the way. So this is the phenomenon that we're going through right now. And so here is it's a table that somebody shared with us that has all the crises since 1977, 77, 81, 90, and so forth, all the way to 2022 year to date. This was as of the end of June. This is the data that we all have available right now. And what it does, it says, well, what was the return of the S&P 500? The S&P 500 is our main index. That's our main, it has 500 companies in the United States, and these 500 companies move our economy in the United States. So the main index that we refer to, our main point of reference in the United States for the stock market, is the S&P 500. And then another index that a lot of people use to measure or to use as a point of reference for the return of your fixed income investments or your bond investments is the Bloomberg US Aggregate Bond Index. What it really means is that it aggregates all durations, and so they can expire in 1 year, in 5 years, in 10 years. They aggregate all sorts of corporate bonds, government bonds, high quality, lower quality. And they give you an example of what a combined portfolio. So when we were saying the core of your portfolio should be equity and fixed income, or equity and bonds. Here's using an illustration of what if you had 60% in the S&P, so in equity, and 40% in the bond market. And it gives you the returns for each of these different crises and periods. As you can see, well, the whole idea of having the bonds and the equities work together and combine them in a portfolio is because they're not correlated with each other. Usually when the stock market is going down, bonds are going up. And when bonds are going down, stocks are going up. But here, for the first time in 2022, we have a drop in both the equity market and the bond market. And it's actually a fairly large drop in fixed income. So if you have someone that says, I just want to be conservative and I just want to be 100% in bonds, AAA, or investment grade bonds, you would have had a drop of 10% this year. And versus the market, the stock market would have been 20%. Here, the combined gives you minus 16%. But what's even more important than that is that when markets are dropping, you have three options. You either reduce risk, right? So you have to sell to reduce risk. You either stay invested, or you have cash and you buy the dip. Those are the only three things you can do when the markets are correcting like they are right now. So the power of asset allocation, or portfolio building and asset allocation, because there's a big difference between trading and investing. When you're trading, you're transactionally managing your investments. You are buying and selling and trying to make a profit and trying to reduce your risk of losses. But when you're investing, it's a completely different story. And there, you need to be disciplined, you need to have a plan, and you need a good structured asset allocation. What that means is how you allocate to different asset classes. And here we're talking about just equity and bonds. So how do you allocate? Do you do 50-50? Do you do 60-40? That's all going to depend on your cycle, where you are in your cycle of life, where you are in terms of your age, what your goals are. And so we make a plan, we have discipline, and we execute, and we supervise. And the power of staying invested, and I'm going to show you a graph about the power of staying invested in a moment, is that when you combine different assets, you reduce the risk of your portfolio enormously. What that means is that when markets are falling, that combination, if it's the ideal combination for you, it's going to drop less than the market. And it should recuperate faster, not faster than the market, but it should recuperate with the market. It shouldn't take 3 years to recuperate the losses that we had in 2022. So that combination is the key combination to Ideally, recuperate your losses as fast as possible, but you can only do that when you stay invested. So the benefits of asset allocation is you reduce volatility because you're diversifying. You have, you don't have anything in one instrument, you have it, or one stock, you have it in many different companies. You stay invested and you reduce your opportunity costs. And I'll show you in a minute why, because you may get out of the market at the worst time. And then technically you miss the best day in the last 10 years and boom, your whole return changes for the next 10 years. Or you buy the dip with a disciplined approach to entering the market or entering bonds or equities, and also a disciplined approach when you exit those investments. So you see the power of asset allocation is key here. This is a typical portfolio, 60-40, so 60% equity. So we were just looking above of how it has affected in the last, year to date, and a 40% exposure to fixed income. And here you have that the 5-year rolling for the same period would have been 9.86 versus 4.48. So the risk dropped by 2% from the one that I just showed you about just a second ago. Even though the return is lower, people are willing to give up that additional alpha or that additional rate of return of 2% perhaps, or 3%, for a lower volatility, because the lower risk means that when markets are very, very volatile and moving quite a lot up and down, your portfolio is going to be steadier. It's going to be less volatile than the market. And when you are an investor, a long-term investor, that's what you want to see in your portfolio. So this just shows you that relationship. As you can see here, you don't have those big drops that we saw in the other graphs in the different crises that we saw. And I could just and go back. Here it is. You have this drop here, you have this drop here, and you have this drop here when you're just all equities. But when you have the combination, you don't see those huge drops. That is the power of asset allocation. And this is just a very simple illustration. But if you add other types of instruments or other asset classes, it actually performs better. So the main risk for the markets today, I think that this is what you have to take with you in terms of understanding what is going on with the market today, is higher inflation. Are we really going to have higher inflation than what we have today? As I mentioned, we are at that 9% mainstream inflation versus the core inflation of 6%. Can inflation actually continue increasing like in the 1970s when we had 15% inflation? Well, we're only 6% away, so I don't know. Let's see how the Fed the Fed manages everything. Let's see how supply chain disruptions start getting better, because they have shown that they're getting better in the last few months. And let's see what happens with the energy crisis that obviously has gotten worse because of the situation of Russia and the fight in Ukraine, and also what they're doing to what Europe and Russia have been debating back and forth as to whether in July, I believe right now in July, we don't know if after I think that they do maintenance to their main oleoducts, and if they finish the maintenance and then turn them back on, we don't know if if Russia is going to continue passing on gas to Europe, and that could be a disruption, an even bigger disruption of the energy market and the economy in Europe, creating a very, very tough recession. And so right now we're looking at Europe quite with a lot of with concern, because if the energy crisis gets worse in Europe and the recession starts in Europe, then this is going to affect obviously global markets and therefore the United States. The Federal Reserve policy, it depends on how I was saying, the dance between the Fed and their interest rates. Their main goal is to get inflation back to 2%. Now, the question is 2% the right number, or should we now be thinking about 3%, or maybe 3.5% should be the normal inflation rate going forward, given the market conditions right now and where we think we're heading. And I think that that's something that they're going to have to reanalyze and see if maybe the 2% target that the Fed has always had is too low. And maybe we need to rethink about what a normal inflation target is. But the way the Fed is going to manage that without causing a disruption in the economy is going to be in everyone's radar between now and the next 6 months, especially the next 6 months. So we have to look out for that. The idea is that the Fed is right now, the rate is at 1.75. So this is the rate that banks lend to each other. And then the bank adds a premium to that when you go and get a mortgage. Maybe your mortgages now are 5.5 or 6% versus 3% a year ago. Well, it's related to this. So that 1.75, we know that in July 26, the Fed is going to raise rates again by another 75 basis points. That means that we will be at 2.5%. So now between 2.5 and 3.5, which is kind of the target rate by the end of 2022, we hope it stays there, because anything above 3.5% could really be negative for a hard recession next year. We think we're in a recession. We don't have a bad recession going on right now, but it could get into a nasty recession next year if the Fed does not manage the increase in interest rates nicely. Obviously, we continue having the geopolitical risk because it affects food, it affects energy markets, and food is already, we have a huge food crisis, and we have a lot of issues related to shortages of certain foods that feed Asia and feed other markets, other emerging markets like Africa. So we're going to be paying a lot of attention to the way Russia, China behaves and how US reacts, as well as Europe. That is in everyone's radar right now. The supply chain disruptions, we're seeing that has eased in the last 2 months. Obviously mainly caused by pandemic, but now the energy crisis, we want to see how much that affects the flow of products. We want to see how that affects the cost of doing business, the cost of energy in general, especially for the winter now that we're going to be facing very high energy costs this next winter. And then obviously a recession, whether we're going to have a soft landing or we're going to have a hard landing. And right now we're all betting for the soft landing. A lot of the players in the market are saying we're going to have a soft landing, and very few are being very negative. I would say most of the people are being optimistic, but depending on how these issues are handled in the next 6 months, we'll know if we'll have a soft or hard landing next year. Now, remember that the markets are always ahead of what's going on with the real economy. So the market has in a way already taken into account all of these issues. And that's why the market, not only because it was too expensive, it has corrected, but because it's already taking into account the possible impacts of these issues in the coming months. Other risks that I would say you want to consider when you are analyzing how to invest, and this is more of a personal thing that I have, as well as with other colleagues that I share this view, is that we also need to look at the environmental impact that companies and governments are having on our environment and how that is being handled. Unfortunately, it's a lot linked with policy and how how governments and new political agendas deal with these issues. The climate adaptation and resilience is a huge one. I was talking to someone who's an expert on the topic yesterday, and we were saying, isn't it incredible that banks and most lenders are not considering the impact, the financial impact of not adapting appropriately the cities that can be affected by the changes in climate. This means that banks, insurance companies, lots of private lenders could have a huge crisis if by any chance we have catastrophic situations with our environment and our climate that can actually create lots of damage, financial damage, and is how are we going to pay for that? So adapting and implementing strategies of resilience, not only for companies, but for cities and countries, are going to be in our radar as we invest in the markets going forward. ESG in action. I mentioned what happens when companies don't do anything about taking care of their effects or how they affect the environment, the social aspects, and governance aspects. Inaction means that financially it's worse for us. So we don't want to invest in companies, governments, and countries that are not doing anything about these issues. Food crisis, it's kind of starting to worry us a bit. We hope we don't get to really terrible circumstances, but all of these risks also offer opportunities. They offer opportunities to invest in the market in companies that are actually addressing these issues. So for instance, in food crisis, well, a lot of companies are trying to come up with substitutes, natural substitutes to food. And the investment in technology that goes into what we would call agrotech, and how you actually how can you actually produce natural, I would say, natural foods in a way, and can feed large populations. It's pretty much in everyone's radar as well, especially when you invest in sustainability. And another issue that we were talking about yesterday with somebody is that in order to continue innovating in technology, well, we need a lot of minerals, right? Natural minerals that come from the earth, like lithium and others. So mining and minerals, that's an opportunity. It means that maybe it's dropping today, but every recession or every market correction is always an opportunity to start investing what the future is going to look like. So even though we have all these risks and it could look a little bit negative, you have an incredible opportunity to invest in the things that are going to help us in the future, like some of the things that I just mentioned here. And these are just illustrations in case you're interested. I'm almost done if you want to have if you have any questions, but I wanted to just quickly show you this because this is how the average crisis behaves. And this is what people normally do. And I wanted to show you this really quick of what happens when you stay invested in a crisis, what happens when you bite the dip, and what happens when you reduce risk. And this is shared by a banking institution with us. And I wanted to share this with you because it tells you that at the end of the day, if you had, so look at all the things you would have had to do in different moments of a crisis. And at the end of the day, you would have reduced your risk. So that means that you would have had to sell at some point to reduce risk. You would have been up 10%. If you would have actually bought the dip because you had the cash or you sold exactly at the moment you had to sell and you were able to buy the dip, then you would have been up 22%. However, if you would have stayed invested and not sell, you would have been up 16%, which would have been better than reducing your risk. That's why it's so important that when you start investing, you have an objective in mind, you have a plan, and you have discipline. You never want to sell when the market is behaving the way it's behaving today. You can reduce risk. That would be the impact. Yes, you can sell if the market's still high and try to take advantage of when the market drops. But if you have a plan and you're disciplined and you have the right allocation for your specific situation, then staying invested is always a winning strategy. Another graph that I thought would be interesting is how you concentrate the best days and the worst days in the market. And the blue dots are I believe the blue dots are the 10 best days in a crisis, and the red dots are the worst 10 days in a crisis. And what it tells you is that the 4-month return in 2008 during the financial crisis between September and December, it went down 27%. Had you sold, right, and you excluded the 10 best days, which tend to be next to the worst day, the best day tends to be right next to the worst day, you would have dropped 58%. You would have doubled your losses had you sold, because you were nervous, and you would have missed out on the 10 best days of the decade. Now, in 2020, the situation when we started the pandemic was the total return in 2020 was 17.4. Look what would have happened if you would have excluded the 10 best days. You would have lost 33% in 2020. And look at this. The best days are around the worst days. They're all clustered in 1 month. So being impulsive and selling and buying and getting nervous. And if you don't have a plan, yes, you're going to be nervous. But if you have a plan and discipline, you stay invested. You don't do anything else. And actually, we can go back in history and always see this. This is 2021, and it just gives you another illustration. The total return was 30%. But if you would have excluded the 10 best days, we had a fantastic performance last year, you would have only generated a third of what you could have generated staying invested. In 2022, this was shared with me by a bank. I don't have all the numbers through June, but just all the way through March, look at the difference. If you had gotten out of the market in March because you were nervous, you would have missed out on at least 3 weeks of 3 best days that we've had so far. Some of the 3 best days we've had so far in the year. You would have actually lost 22%. So that's about it.